This is Options Delta Explained, what it is and how to trade it. This is taking far too long. Rudes, my editor, I know you're watching this. Let's skip to like when it actually him starts talking. Nobody wants to sit here for 28 seconds with nothing.
What's up, everyone, and welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're talking about delta. So we're going to start getting into the option Greeks. We're going to start off with delta, which is probably the most basic to understand.
Hey, Senior Wahoo just ordered himself an 80 Delta mug. Very cool.
And how that relates to an options price. And then tomorrow we're going to wrap that into gamma. So gamma has a direct relationship with delta, so it's going to be a nice pairing. And then we'll finish off our conversation with theta on Tuesday. We've got some other Greeks like beta and vega, but we'll get into those later. I think the big three that we want to learn about are going to be delta, gamma, and theta. So let's start off with delta and what that means with an options price. So when we're talking about delta, we're basically talking about the rate of change of an options price given a $1 increase in the underlying price.
So before he gets super into it, that's always how I like to describe it. And of course, there are going to be other uses for this that we'll talk about in a little bit. I'm 100% sure of that. But for example, I love to trade the 80 Delta ballpark. So this one's just on my screen. I didn't pick it ahead of time. AMD October 17th. 80 Delta is going to be roughly the 140 strike. So you could see 78 or 83. So that means for every $1 change in AMD, this option price will grow from 1910 if you were to buy it by 78 cents. Now, gamma is the rate of change, how this accelerates here or decelerates here. We're not going to talk about that. That'll be next week. But for every $1 change that AMD goes up, my option is going to go up 78 cents. Cool. I like it. Now, let's look on the flip side. Let's go over here to the 20 delta. Okay. Remember, we're looking at the 80 delta first, 20 delta second. This is the 175 strike. For every $1 change in the 175 strike, this one's going to go up 20 cents. Big difference. Big, huge difference. This is a leveraged investment. This is where I hang out. This is lottery tickets. I don't want you hanging out over here ever, 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 ever.
So what that basically means is that different options have different deltas, and you can see those on any order chain. So if you're in Doe, you can change the column to delta. You can view them. Whatever table you're on, whether it's the curve view or the table view, you can change that to see the delta and see how that changes for out of the money and in the money options. But the four big things we're going to talk about today with delta, and this big triangle is what you might see in math equations. So if you look into skinny on options math segments where Jacob is talking about basically big equations, we're going to see this triangle here, and that's basically what we're going to see when you're looking at delta, and you're going to see that on the trade pages as well. So we're going to talk today about traction and how that basically affects option prices. We're going to talk about directional risk, how we can use delta to hedge, and also its relation to probability of being in the money. So let's get right into it, and let's talk about traction. So when I'm talking about delta and traction, the way I like to think about it is think of a drag racing car and think about the types of tires that are being used on that car. So if I have a low delta option, I might be throwing on Honda Civic economy tires on that drag racing car. We've got so much power, but the wheels are probably going to spin because there's not enough traction in that option.
This is a decent analogy. I like that. That's kind of what I was just talking about over here earlier, right? This 20 delta, the stock price is going to move $1, and this is only going to move 20 cents. This 80 delta, the stock price is going to move $1, and this is going to move 80 cents. That's a decent analogy. I don't mind that one.
But if I have basically drag racing tires that are massive and they're gonna go with the car, I might have a high delta option. So what this basically means is with traction, the higher delta you have, the higher the option price is going to change in relation to an underlying price. So when we get down to it, positive deltas range from 0 to 1.0 when we're talking about option deltas. So when we're talking about stock deltas, you can have 100 deltas, which would be 100.
Okay, I'm glad you mentioned it. For every stock, a options contract is worth 100 shares of stock. So if you were to have an equivalent level of deltas in stock, that would be 100 shares of stock for every one option contract. And the deeper you go in the money, the closer you get to 100. You can never max it out. And he's probably going to say exactly that.
100 shares of stock, which we'll get into later. But when we're looking at options, you're going to see that range for positive deltas between 0 and 1.0. On the flip side, negative deltas are going to be ranging from -1 to 0. And basically, all you really need to know with traction is that deltas that are closer to -1 and +1 will have more option price traction. So if we look at an example here, we can clearly see that. So we've got a $1 increase in the stock price. So if I've got an option that's a 25 delta and the stock price goes up $1, so if I have a positive 0.25 delta and the stock price goes up $1, then the option price should go up 25 cents. So basically you can think of it as like a ladder in relation to, or like stair steps in relation to the options price and the underlying price. So if I've got a $1 increase in the underlying price and I have a 25 delta, I should see a 25-cent increase on that option. Also,
Now, granted, that's not always the case. That's not always the case. One thing that I have found, this is Chris speaking anecdotally, is that your deltas grow really, really, really fast, and you actually are going to get paid greater than the delta that's shown on here. So, for example, let's say AMD launched, went from 155 to 175 today, whatever the case is, right? Um, you would, in my personal experience, you would have done better than 78 cents for every $1 move. You might have been able to get 85 cents for every $1 move. But also, when it starts to pull back, that additional delta that you've gained evaporates very, 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 very quickly. So imagine it went up $20. You didn't get out today because you're following your plan. It comes down $7 the next day. So it's up net $13. It doesn't always fit with the 78 delta right there. And it can be really frustrating because sometimes you're like, oh, I should have made so much more, or I can't believe I made this much more, right? Albertone said the same thing, right? It's not linear at all, and it's what he's also noticed. But this is also one of the things that is really cool about selling into strength. If you sell on the way up, your options delta, I'm sorry, your option price could outpace the delta that it was originally at the beginning of the trade. But if you wait for it to crest, have a trailing stop, and for it to come back down, that delta may not be as strong. It's very interesting. Very interesting. Just anecdotal observations here.
if I have a higher traction delta, like 85, which is going to be a pretty high delta. So if I'm looking at calls, this is going to be a deep in the money call if I'm buying that call.
Hell yeah, that's where I live. Deep in the money calls. Let's go.
And for puts, it's going to be the same thing, deep in the money if I'm buying that put. But in any case, if I have an 85 delta and a positive delta, if I have a $1 increase in the stock price, now I should have an 85-cent increase in the option price. So you can see that it's basically traction, and the higher the delta there is, the more that option price is going to move 1-for-1 or closest to 1-for-1 with the stock price. Now, if I had an option delta here that was 1.0, then if I have a dollar increase in the underlying price, I'm going to see a dollar increase in the option price. So that's when you get super deep in the money, and basically the options are trading more like stock than options. So the next thing we're going to look at is the directional risk here. So when I'm talking about directional risk, when I say positive deltas, I would have a long market assumption. And that's because with the example we just showed.
Now, one of Tasty Trade's big things, and I don't understand, is they love being delta neutral. Now, what does delta neutral look like? Delta neutral looks like balancing the, let's say, and this is gonna drive me crazy, but this is what they would say: sell a 16 delta call, sell a 16 delta put, roughly. Your total net deltas. Wonder if this looks like I want it to. Your total net deltas are going to be basically zero. Let me see if this does what I want. Let me zoom out slightly. Yeah. No. Hang on, I'm trying to use this what if tool inside of trade year. I don't want the first date. Just want the okay. Clearly I'm not doing something right. That's fine. Let's go back over here. So your total net outlay in deltas is 0. You know, if you're doing 16 on both sides, your total net outlay in deltas is 0. Why would you want that? Why would you want that? That would allow you to profit if the stock were to go sideways. So let me remove drawings on here. Let me draw out what this would look like. 180 and 135. So you're basically capping it between 180 and 135. So let's do that right here. 135 to 180. Right. So you're saying, all right, cool. Well, as long as it stays between those 2 points by expiration, then I'm going to collect the theta decay on each day. Here's the problem. You must let time pass. As it's going down in value and you sold it, you are actually gaining profits in your account by collecting the theta. Yeah. Now, on the outset, this sounds brilliant, right? Oh, yeah, of course. Look, it can go up, it can go down, it can go sideways, and I'm going to get paid either way. But we can already observe right here, this is in a downtrend. Imagine this continues on this downtrend, right? And you have to wait. You cannot get paid any faster until October 17th. Only on October 17th will you make the entirety of your trade. And that would be all the way out to here, right? So AMD could potentially steamroll all the way through the entire time because it's in a downtrend. Now, here's the thing. You want to be trading with the trend. So by doing this, you're boxing in the trade. And this is what I thought was brilliant. When I lost so much money with 84% win rates, I was still losing so much money because I was like, look, it can go up, down, or sideways, and I make money. The problem is that you will fight a trend one way or another, up or down, or, and in cases that happened to me, it would do both. It would fight me up, and then it would turn around and fight me down, and it was so frustrating. It sucked so hard. I hated it. And yet, how much would I have been paid total for this trade? $15. Why'd I sell those options for pennies? Literally $15. I don't know how much capital I'd have to put up. But yeah, just an absolute shit show of a trade. I don't know why anybody would do this. But back over to this.
If I have underlyings increasing in price and I have positive.
Okay. Ozzy Ian, this is a brilliant question. Why not go shorter on expiration? Okay. So let's pull that through. Let's go to September 12th, so 2 days from now. Let's price out what it would cost to sell a 16 delta call here, and then sell a 16 delta put. 16 delta put over here, right? So our total deltas in the trade says 83, but that can't be right. Would be 16 deltas on the top, 16 deltas on the bottom, 162 and 148. So you're gonna get paid how much? 94 cents. So you're gonna get paid more, but we've blocked it in at 162.50 and 148. 162.50 and 148. So we'll draw a second box on here. 162.50 and 148. So now you're like, okay, listen. I know I could sell it out further in time and have more room, but if I need that theta decay to happen really fast, I am boxing in that trade so itty bitty tiny. And it is a very, very, very hard trade to make profitable. Do people do it and make money? Sure. But when they do it, they also set themselves up for big risks. Big risks. So let's do this more here.
Positive deltas that are going to increase that price as well, then basically I have a long market assumption. So basically, if I'm buying a call and I want that underlying to go up, I'm going to have positive deltas with the call. Negative deltas are going to be short the market. So it's the opposite. So if I have negative deltas and the underlying goes up, then I would be losing money in that position. But if I, for instance, buy a put or sell a call, those are going to be negative delta directional assumptions with the market. And neutral deltas or zero deltas is basically going to have a neutral market assumption. So if I have a very
And so to that question, Ozzy Ian, this is a neutral market assumption. This is a bearish market assumption. And my dude, you can definitely make way more money being directional than just selling straddles or strangles. That's what that would be right there. Way more money.
various positions on, and I'm trying to keep that delta neutralized. Basically, if the underlying goes up or the market goes up or down and I have zero deltas, that basically means that my directional risk is going to be much less than if I had positive or negative deltas. So that's what we like to do here at Tasty Trade, is try and keep our deltas as neutralized as possible.
Which I completely, wholeheartedly, unequivocally disagree with. I want as big as deltas as possible, because that means when I am in the trade and it is trending, and in this case, trending down, I can make big, big, big bucks. And if I'm wrong, I just get out of the way. But if I'm trying to sell something delta neutral, I have to sit here and wait for weeks to get my money. And it could do all kinds of stuff in the meantime. But if I'm right, I can make big bucks. If I'm wrong, I just get out of the way and I take my loss and I move on.
Possible, so that we're all about the duration instead of direction. So we're all about durational trade.
Okay. We're all about duration versus direction. I can't tell you how much. This is why I say selling options is an insidious game. We haven't even really talked about delta all that much. Selling options is an insidious game because, to this point, right? Let's define insidious real quick. Insidious definition. I know I spelled it wrong. Shut up. Proceeding in a gradual, subtle way, but with harmful effects. Okay? In a gradual, subtle way with harmful effects. Insidious meaning on a day-to-day basis, you have to sit there and get punched in the face over and over and over and over, because you're thinking, well, I've got time. Listen, I went through this. I know what I'm talking about. I experienced it, and I don't want you to go there. You know, it goes down a couple days. You're like, no big deal, right? But day after day, it moves a little bit further and a little bit further and a little bit further. And then it goes past your break-even point, and then it keeps going further down. And you're looking at it, you're like, that's fine. I still have 2 weeks left. We're only halfway through this trade. It's fine, right? It's no big deal. And then it starts to come up a little bit, and you're like, see, I told you. And then what do you think happens at that point? It turns around and it goes back down, and it gets worse and worse and worse and worse and worse. And it is an insidious trade because you sit there with the hope and prayer that it just comes back to be within this range that you arbitrarily defined at entry. And if it doesn't, then you just lose your face, because not only are you having an insidious nature of this, but it breaks the golden rule of trading, which is never put yourself in a situation where you can lose more than you can make. Let's try to get back on topic with delta here.
So if we keep our deltas neutral, that's going to help us minimize risk to the upside or downside. So again, when I'm looking at options, if I am buying a call, that's going to have a positive delta, because at the end of the day, when I buy a call, I want the underlying to go up, because a call option gives me the right to buy 100 shares of stock. So I want that underlying to go up to be successful. And that's why the option is going to have a positive delta, because if that underlying actually does go up, I'm going to see profits if I'm buying that call. On the other side, if I'm buying a put, then I would have negative delta. And that's because buying a put gives me the right to sell 100 shares of stock. So if I buy a put at a certain level and then the stock goes down, I can now sell the shares higher than what they're worth in the market.
Okay. I'm actually really stoked about this right now, because to Aussie Ian's question and example, those prices were from yesterday. The market just opened and AMD is up over 4% this morning. Okay. It's up over 4% this morning. So that 162.50 that we were trying to box it in at could be immediately gone. Immediately gone. Just that fast. Just that fast. Your delta neutral trade becomes an insidious, getting punched in the face type of trade. Now you're like, come on. All I wanted you to do was not do anything. That because yes, that's exactly what stocks do. They don't do anything. They certainly don't go up and they certainly don't go down. They go sideways all the time.
Marketplace. So that's going to have a negative delta. Now, if I'm looking at selling options, it's just the opposite. So if I'm buying a call, it's going to have a positive delta. And if I'm selling a call, it's going to have a negative delta. And if you just think of the transaction, if one person's buying the call and one person's selling the call, one person's going to want the stock to go up while the other was going to want the stock to go down. So when I'm selling a call, I've got a negative delta, and you'll see that reflected in the options price, as you'll see there. So with a short put, it's just the opposite of a long put. So if I'm long a put, I want the option underlying to go down. If I'm short a put, I want the underlying to go up. So that's a pretty quick way how you can visualize the options and how the options are going to have these deltas when you're trading them. So the next thing we're going to look at is going to be hedging. So
I just noticed this was recorded on 9/19 of 2015. We are 10 years and 1 day watching this after it was recorded. I just thought that was kind of interesting.
let's talk about how we can hedge and how we can use deltas to hedge our positions. So we can.
By the way, I can tell you unequivocally on 9/19/2015, I was probably watching this with the mindset of selling options. Now I find that incredibly interesting.
Can use options to hedge stock. So this is basically what we do in maybe an IRA account where I might be holding more stock shares than I would be in a margin account because I don't have that additional leverage in an IRA account. So maybe I'll be trading covered calls more, or having naked stock positions and then looking to hedge those positions when I think that something might be going on in the market, or when implied and volatility is high and I just want to collect that premium. I'll be looking to hedge that stock. So if we look at a couple of examples here with hedging, let's say I've got 200 shares of stock, which is.
So before we get too deep into this, I despise the idea of hedging. Now, hear me out. Let's say that you're long AMD. Let's say that you decide to go long AMD on the 10/20 price over 50 right there. Okay. And you bought AMD stock. And as you can see, AMD ripped higher with this trend template in place. AMD ripped higher. But what if it turns around? I need to buy puts and make sure I continue to buy puts all the way up. This is the wall of worry, by the way. I need to buy puts all the way up. That way, if it does turn around, then I won't lose as much money. So rather than enjoying all these gains all the way up, you decided to hedge and buy puts. Therefore, taking your profits, let's say that you're up $50 a share in this case, but you've bought enough puts all the way up that's eaten up, I don't know, $15, $20 a share. Why in the wide world of sports would you ever want to hedge? I feel like hedging is the stupidest thing you can do as an investor. If it doesn't work out, get out of the way. Close the trade. What's the point of hedging? The point of hedging, in my opinion, is to throw bad money out the window. You've got great money on the table, just throw the bad money out. This is dumb. But you know what? What do I know? What do I know? Just a random guy on the internet. Don't listen to anything that I say.
Going to give me 200 deltas. And that's because if I have 200 shares of stock and the underlying goes up $1, I should see a profit of $200. And that's just because I have 1-for-1 movement since I actually own the stock. So if I'm looking at a covered call, what I could do is hedge the position, but not fully hedge it. So this would be an under hedge. So let's say I've got 200 shares of stock and I'm looking at selling 2 out of the money calls for a -30 delta. And again, when I'm selling calls, it's going to have negative delta. So this is going to be me selling out of the money calls, just collecting premium to reduce my cost basis. So if I've got 2 -30 deltas, I've got -60 delta. So instead of me having all the directional risk of 200 shares or 200 delta, now I only have 140 delta. So basically, I'm collecting premium, reducing my cost basis, and I'm reducing my directional risk if the underlying does.
Cover calls seem like a brilliant idea. They really do. I understand that. Cover calls is when you own 100 shares and you sell a call option against it. But let's say that you were doing covered calls on AMD. And let's say that you started to do those covered calls down here and you sold a call at like the 115s when it was at 100 and it blows through your 115s. You don't have those shares anymore. They got called away. They're gone unless you redo the trade. And as it then continued up to 150, what was the point? I don't know. I just get frustrated at these concepts. It's super sexy, right? It's super sexy to say I've got a strategy that works up, down, or sideways. It's super sexy to say I've got a strategy that offsets the cost of the stock that I bought. There's all these ways that you can make a strategy look super sexy, but you don't need to. You really don't need to. You can keep it really, really simple. And that's how I go, right? Going deep in the money long calls is a leveraged investment. I am paying as little extrinsic value as I can to make sure that the theta is working against me as little as possible, but I'm also maximizing the delta. And if a stock moves like this, and let's say it went up $50 a share, and I paid round numbers here, it goes up $50 a share. I bought the calls for $5. I just made 10 times my money. I made 1,000% return. Instead of making a 50% return here, I made 1,000% return. That's legitimately what it's like when you buy deep in the money long calls and you have a big, giant, beautiful move like this. Is rolling an option a form of a hedge, lowering risk by changing a position? Somebody else talked about rolling options. That's why rolling is better than hedging. You reduce risk, but you don't change your outlook on the overall trend. Let's talk about what rolling options is. This is one of the coolest ninja hacks that I ever came across in trading. Let's say you own the 145s. The prices have gone up, and now you're, in fact, let's actually go out further in time. Let's say that you own the 145s here at the 76 delta. It's been a beautiful trade, and now this 76 delta is maybe like 86 delta. You just gain 10 deltas on here. The trade is working out beautifully. You can then roll to another strike. So all you do is close the 145 and then open the 150s. You're now back at the 76 delta where you started, but you've taken partial profits and put them in your bank account. Nobody can take those from you. You've reduced risk in the trade because if it cost $10 originally and you took $4 right away, that partial profits now means your total risk in the trade is only $6, which is awesome. And then the best part of all is you keep your bullish bias. You keep the trade alive. It is such a ninja hack. Yes, exactly. The ninja creamy hack of all hacks.
End up going down. On the other hand, I can also do a full hedge. So what's important to note is that delta changes. So that's gamma. Gamma is the change of delta. But what I can do is temporarily give myself a full hedge. Now, if the underlying goes down or up, then this delta is going to change because the calls, or the delta that the calls actually have, is going to change as well. So if I'm looking at a full hedge of these shares, let's say I'm happy with what's going on, or maybe I've seen a pretty big spike up in the underlying, and I just want to fully hedge that
You're my soda pop, girl, you're my soda pop. Thank you for that.
position. Let's say maybe I don't want to close it, but I want to collect some premium and basically offset any bounce it might have to the downside. So I might look at a full hedge. So if I'm looking at the money calls, basically an at the money option is going to have a 50 delta. It's basically a 50-50 shot either way. So if I'm selling calls, if I'm selling 4 at the money calls that are 50 deltas each, then I'm basically having a negative 200 delta. So if I have positive 200 delta with my 200 shares and negative 200 delta with my short options, then I'm going to have a neutralized delta, or a delta of 0 at that point in time. So basically I'm collecting the
Sorry, I tuned out. If you found that interesting, type a number 1 in the chat. If you also tuned out like me, put a number 2.
premium. I'm reducing my cost basis, and regardless of what happens with the directional assumption of that stock, I'm basically giving myself a full hedge temporarily. So let's take a look at another thing we can use delta for, and that's going to be percent in the money. So this is a really quick way to determine what your percentage of being in the money is. So if you look at an option chain, so on Thinkorswim or Dough, you can change the columns to show you delta or probability in the money. So what you'll see is delta basically goes 1 for 1 and looks almost exactly like probability of in the money. There's going to be a few percentage points difference, but when you're looking at options, they're basically going to have the same thing. So if I'm looking at a 25 delta, it's probably going to show me a percentage of being in the money of close to 25%.
Okay, so for those of you who are still awake, this is great. This is another way that people use delta. And delta, remember, the concept of delta is the rate of change for the option price for every $1 change in the underlying stock. However, one way that you can use delta, an approximation, is the likelihood of it being in the money at expiration. So, for example, when you are trading, you want to maximize intrinsic value. That's how deep it is in the money. That's the moneyness, right? That's the Scrooge McDuckiness of it, right? That's how much moneyness we have, is maximizing intrinsic value. Intrinsic value is calculating the price of the stock minus your strike price. So let's do that together real quick. AMD is trading at roughly 160 minus our strike price, 145, gives us $15 of intrinsic value. Wow, it's almost like I know what I'm talking about. Okay, that is what we're trying to maximize here. All options are trying to maximize the intrinsic value. It doesn't matter who you are, at what time, ever. You are trying to get to the most amount of intrinsic value. Extrinsic value is the part that will decline over time. Okay, this declines over time. We want to minimize that if we're buying options. So the deeper in the money we go, the less extrinsic value there is. Now, whenever you're starting with an 80 delta, you're already saying, you know what? Basically, 80% chance that this will be in the money if I held it all the way to expiration. That's a great place to start. That is a beautiful place to start. If you're buying out of the money options, you're basically saying in this case at 18 delta, there's an 18% chance that this is going to go in the money. This is why I like to reference this as lottery tickets, leveraged investments, right? We can't predict the future, and that's why there's never a 100 delta. But the likelihood of it being in the money expiration, growing the intrinsic value as it gets closer to expiration, is highest deep in the money. That's where you want to live. Now, I didn't make this up. I learned this from a billion-dollar hedge fund manager named Larry Hite, one of the original market wizards, specifically sat me down and taught me this exact trading strategy. Get as much leverage as you can and pay as little as possible for the pleasure to do so. And paying as little as possible is that extrinsic value. There you go. Look, we actually do learn a ton on Options Deep Dive Wednesday. If you are learning a ton, type the word deep in the chat. If this is not clicking for you, that's okay. Let me know by typing the word click, right? Deep if this is working, or click if it's not clicking.
So again, options delta is roughly equivalent to probability in the money. So let's look at a few examples. So if I'm looking at an out of the money option, I'm looking at a short call. So that's going to have a negative delta of 30. And if I looked at that probability of being in the money, since I'm selling an out of the money option, I'm going to have a 30% probability of being in the money. And again, when we're selling options, we want them to remain out of the money. So if I've got 30% probability of being in the money, I know that I've got a 70% chance probability of being out of the money. And a quick way we can calculate that is just by taking 100%, which is the probability, and you can subtract any number that you have. So if I have 100% and I know the probability of in the money, I can subtract the probability of being in the money from 100 to get the probability of out of the money, and vice versa. So I know if I've got a 30% probability of being in the money, I've got a 30% or 70% probability of being out of the money, and that's a high probability trade. Now, if I'm looking at the money, I've got a 50 delta here, short put. So again, it's a 50-50 shot if we're at the money. So it's going to have that 50% probability of being in the money, which is going to give me a 50% probability of being out of the money. So this really is where we're talking about maybe buying options where you're getting that 50-50 shot if we're buying at the money options. If we're selling at the money options, we're going to still be collecting that premium. So it's going to be a little bit higher than a 50% probability of profit because we have that better break-even point. But in terms of delta, it's going to be 50-50 probability in the money or out of the money. Now, let's look at an in the money option. And this is going to show you why we don't sell in the money options. So if I'm looking at
Somebody's selling them to me. I'm buying the mess out of them. Somebody's selling them to me. I didn't say it. You said
a
it.
short call that's in the money, it's going to have a higher delta than 50. And that's because if you look further out of the money with calls or puts, doesn't matter. When you're looking out of the money, it's going to have a lower delta because it's going to have a lower probability of being in the money. But the further you go in the money, it's going to have a higher delta and a higher probability of being in the money. So again, if I'm selling an option,
and that's what you want. And that's what you want. Because remember, our goal is to what? Pop quiz, answer in the chat. Our goal is to maximize what value on the options chain. Pop quiz, skinny buff guy. Pop quiz, wake up. Mikey Mike, the market maker, selling them to me. Patrick, I totally get it. This is the reason that he couldn't understand options, right? And you don't have to learn all the deep Greeks and everything. But if you focus on specifically one strategy, buying the mess out of the deep end the money calls, that makes life so much easier. Pop quiz, very good. Random guy, CO Hart. There we go. Correctional Officer Hart. I saw your chat on that. There we go. CO Hart says intrinsic value. Very good. A succulent Chinese meal. No, wrong answer. You fail. You get nothing. Maximizing intrinsic value. Intrinsic value. That's right. That's exactly right.
I want that to be out of the money at expiration so it expires worthless and I can keep that entire credit. If I'm looking at a -60 short call, then this is going to be a 60% probability of being in the money, which is a 40% probability of being out of the money. And again, I want this to be out of the money at expiration. So if I'm trading 40% probability of being out of the money, it's going to be a low probability trade. So I wouldn't look to do this to enter a trade outright. So that's why we're selling out of the money options here at Tasty Trade. So,
but not here.
Let's look at a few takeaways here. So delta, again, is the rate of change of an options price given a $1 increase or decrease in the underlying price.
I agree with that wholeheartedly because that's what it is. That's what I like to look at delta as is the speed at which you're traveling down the interstate. Okay, if you are traveling at 20 miles an hour, right, you're not going very far very fast. If you're traveling at 87 miles an hour, you're driving on that tollway around Austin where it says where the Tesla Gigafactory's at, and it's, I think the speed limit on that is 85. That's where you're going. I forget the number, but yeah, you can blaze through that area. I mean, because there's nothing out there except for the Tesla Gigafactory, and also the Circuit of the Americas. But when you're looking at delta, that's the way that I like to look at it, is that is the speed at which you are gaining value in your option, aka the speed that you're traveling down the interstate. Delta signifies your directional risk and also your directional profits, right? Your directional profits. Now, here's the great thing about delta. As you'll notice, and we'll talk about this more next time when we talk about gamma, is that options are so cool. When you buy the deep in the money options, let's say you bought the 90 delta, okay? Let's say you bought the 90 delta. As it goes up in value, that option price gains deltas. So it's helping you. The deeper it goes in the money, the more it helps you. But let's say that's a losing trade. The further it goes towards at the money, the less the deltas are hurting you. What? How cool is that? So the deeper you go in the money, the more money you're making, the more money you're making. If it goes against you and you're losing money, it actually slows down on how much you're losing. How cool is that? And gamma is the rate of change in delta. Yeah. Lastly, delta roughly equates to the probability of being in the money. Yeah, and you want to maximize that. You want to maximize the intrinsicness. You want to maximize the moneyness, the Scrooge McDuckiness of the money. And don't even think about hedging. Hedging is dumb. That's a waste of time. Don't even think about it. So there was a ton we covered today, right? I really like watching these videos because even though we have a disagreement in how to trade, I feel like my strategy, because I have lived through losing so much money trying to sell options, and I've lived also through making so much more by buying the options. At the end of the day, the goal is to have more money in our account than we did yesterday, of course. But there's a lot easier ways to do that. And in my opinion, buying the deep in the money calls, having that high delta working in your favor makes life tremendously easier. But you do you, right? And listen, if you're ready to save time, make money, and start winning with less risk, YouTube's popping up 2 videos right now. You should totally click on one of them and have a fantastic day. We'll talk soon. CEO Hart says his brain melted. Which Greek is overinflating your tires? It's shut up Greek. That's the Greek, Rick. That's the Greek. It's the shut up Greek. All right. So plan for the day. Sitting in cash, not effing up. Actually, let's go over into the platform. Let's go over into OVTLYR real quick. Oh, I turned off my screen share. So plan A is live, by the way. Plan A is live. I did make a change. It was set in stone until yesterday. I made a change. It was actually overnight. I was thinking about this. I removed my $20 snob filter, but I am going to add a $10 filter for options availability. Because if you look at stocks that are under $10, you're not going to find a lot of options. A lot of them don't have any options at all. It's kind of a waste of time. So I'm going to put a $10 filter on. I don't want to call it a snob filter. I would call it a liquidity primer. How you like that? A snob filter versus a liquidity primer. Let's go look over at the market real quick. Let's go to SPY. Look at that. AV go, gap, and go confirmed. Huh. Look at that. It sounds like Rick has learned something. Look at this. Look at this. We have a gap of at least 5%. That's how we have quantifiably measured it. This is 8.29%. And a gap and go is when within 3 candles, if it is not closed underneath the low of that, then you could actually see a huge trend starting to develop, and this being like the catalyst to have started that. To Rick's point, gap and go confirmed until it closes today. I would wait until the close of today, Rick. But yeah, a gap and crap is when it gaps up like this and then comes right back down. Microsoft had exactly that. It gapped up, closed down within 3 candles. There you go. There you go. Carol Catherine was looking forward to the behind the scenes. Carol, my editor sent me something. Hold tight. I have to download it from her and then upload it into StreamYard. Y'all are going to love this. Carol Catherine has been ultra creative lately. All right. So I'm downloading something. Here's a preview. Chris Yule is a badass trader. I don't know where she got that idea from. I had nothing to do with it. Okay, I'm downloading it right now, Carol. And as soon as that downloads, I'll upload it into StreamYard, and then we'll play that song on the way out. But in the meantime, let's take a look at the markets. So one huge part of plan A is you want to see the fear and greed on the market going up, and we don't have that. It's down at 69.19 today from 69.83. And if you've been struggling the last several weeks, this is probably part of the reason why people are losing interest in the market. I can see in the YouTube data, people are losing interest in the market. That's not what you want. You want people getting greedy AF and catching that uptrend on the greed and that's going to make your trading so much more effortless. So much more effortless. Uh, let's also go to hold tight. Let me obfuscate my screen real quick. Okay, the download completed. Um, let's go to what is that called? CME FedWatch tool. This is one of the greatest free inventions of all time. Bookmark this. Go Google up CME Chicago Board of Mercantile Exchange FedWatch tool. This is such a cool tool. So when I worked in consulting, for those of you who don't know, I spent 12 years consulting with financial institutions. I worked directly with their C-suite executives, showing them how to get this, make more money and have less risk, specifically, and it all involved around watching the Fed. Watching the Fed. The Fed is meeting September 17th. There's an 88% probability of at least a 25 basis point cut, an 11% probability of at least a 50 basis point cut. There's a 100% probability of a rate cut, is what it's saying by next week. By next month, we're saying at least 25. The holding flat is not an option. At least a 25 basis point cut at 18%, 72% of at least 50 basis points, and then even some people putting a 9% chance of a 75 basis point rate cut. So basically, rate cuts are coming. The market is pricing that in bigly. But I would say that because of the uncertainty and what happens with rate cuts, we have all seen it. It can be up 5 minutes after the rate cut and then be down bigly by the end of the day, or be down bigly and then by the end of the day it's up 1.87%. We have seen that. That kind of volatility spooks a lot of investors, myself included. I don't want to be trading on that date. Is what it is. Albertone says, if that's so, we would have a higher shorting expectancy than plan A. Yeah, I'm going to be sitting in cash and not effing up for sure. What does a rate cut do to SGov? That's a brilliant question. Okay, so SGov is 0 to 3 month treasuries. Now, 0 to 3 month treasuries should, most dangerous word in finance, should be impacted by a rate cut, because the rate cut is the overnight rate. That is not the same as the 0 to 3 month treasuries. Overnight rate means if I am an institution, let's say it's the Bank of Chris. Bank of Chris needs to make money on my deposit. Let's say I have $5 billion in deposits from all of my depositors. I then take that $5 billion and I put it in the Fed. It's called an overnight sweep fund. And I'm making, let's say current rate's 4.25. I'm making 4.25% annualized by doing literally nothing other than putting my money from my account in the Fed's account for 12 hours overnight. It's easy money. It's so easy money. However, that's not the bond market. The bond market will price whatever they're going to price it to. And honestly, it can decouple. It can disconnect. And when that happens, which is what we've seen for ages, right? There's a lot more uncertainty in the market. Significantly much more uncertainty in the market. So the market right now is showing less greed, more fear. So I won't be trading anything. But one thing that we were talking about in plan A, basically plan A is having all OVTLYR 9 lit up. And I'm really, really excited about that because that's what we've been talking about for ages. Let's go over to market breadth real quick. No new uptrends. And we do have some new downtrends, but not enough to change the DocuChannel score. Market breadth is going down. This is just not the time to be getting into the market. Right now, the time, in my opinion, the trade is sitting in cash and not effing up your portfolio. And I think it will be for a minute. All right. Let me upload that song from Carol Catherine. Hopefully it won't take too long. Yes, to that point. Scott mentioned yesterday, if you are deciding to put on trades while the fear and greed is moving down, you are fighting a battle that is not worth taking. The expectancy is negative 1.7. Negative 1.7. Which means when the greed is going down in the market, and you can just have this filter, just this one filter. If the greed is going down and fear is going up, you could honestly just sit in cash and not F up your account. Thank you for reminding me of that. So we're looking at market breadth on the 10 EMA and no what is the word I'm trying to think of? No nuances. If it's over the 10 and coming down, that's fine. It's still over the 10. If it's over the 10 and going up, that's fine. If it's over the 10 and over 75, that's fine. Doesn't matter. You will see right here that the 4.0 signals, there's a lot more sell signals coming through than buy signals, because I don't even see a point in time where 4.0 had over 75% buy signals. So 4.0 is a lot more risk averse. This is not, oh, it just came through. All right, I'm out of here. You guys have a fantastic day. I will see you in this afternoon's live stream. It's invitation only though, so only if you're an outlier. We'll talk soon.
Chris Sewell is a badass trader. Options light his fire like a skyscraper. He laughs at charts that shout fundamentals. He moves with a setup sharp and mental. He shows you how to be a better player. No schemes, no lies, just truth from a slayer. He trades for the thrill, not for the fame. No dream selling here, just love for the game. Follow this random guy online with deep thought Joe, my Hessian line, and Sky do back tests while hunting grails. Together they ride market wins and sales. No holy grails, no magic beans, just strategies born from countless screens. He says lose the greed, keep your head, trade the market, not the dreams you're fed. He shows you how to be a better player. No schemes, no lies, just truth from a slayer.